Hey guys, welcome back to my channel. In today's video, I'm going to be talking about index funds, mutual funds, and ETFs, and their differences and similarities. If you are confused in any way about what these investment funds are and you're trying to figure out which one's right for you, be sure to stick around because I think this video will be immensely helpful for you. If the link didn't already give it away, this video is packed with details and covers a lot. So I added a timestamp outline in the description below so you can quickly jump to whatever you're most interested in. And while you're down there, don't forget to drop a like to support this channel and subscribe so that you don't miss out on any new videos to help you grow your wealth and achieve financial independence. Also, real quick, after you watch my video, be sure to check out this one right here by your wealth mentor Tiffany Thomas, where she adds additional perspective to these investment funds, which I think is really informative. I linked her video up at the top here and down in the description, so be sure to check it out. Okay, let's get right into it. The first thing I'm going to talk about is at a high level, what are mutual funds, index funds, and ETFs? And then I'm going to cover them in 5 different areas. The first area is passively managed versus actively managed. The second area is the expense ratios. The third area is going to be the tax implications. The fourth area is going to be the minimum required to invest. And the fifth area is going to be whole shares versus fractional shares. And at the end, I'm going to guide you through 3 questions that will help you decide which one may be a better fit for you. Let's first start with mutual funds and what they are. So a mutual fund is an investment that pools money from many investors and buys a collection of stocks, bonds, and other securities. And that collection is commonly referred to as a portfolio. By buying into a mutual fund, you become a part owner of the portfolio and you're able to get instant diversification so that you don't risk losing all your money in a single investment. And you're able to get that diversification at a much cheaper cost than if you try to do it yourself. Today, there are thousands of mutual funds that are managed by hundreds of companies, some of which you probably heard of like Vanguard or Fidelity. These companies collectively manage mutual funds worth trillions of dollars because they have become the investment of choice for millions of people to grow their wealth. The first modern mutual fund is considered to have been introduced in the 1920s and really took off in popularity in the 1980s and 90s. But more recently, due to a number of reasons which I'll get to in a moment, a type of mutual fund has really grown in popularity, and these are called index funds. There are 2 important things that distinguish an index fund from all other mutual funds. So mutual funds can either be actively managed or passively managed, and closely related to that is that mutual funds can either be tracking an index or they don't. So index funds are mutual funds that are passively managed because they track an index. What I mean by passively managed is this. There is no team of stock pickers or a highly paid Wall Street expert that's choosing which stocks to include in the fund. Instead, the stocks and bonds that are part of the fund are being decided by an index or a market indicator, hence the term tracking an index. For a fund to track an index, it means that the fund is made up of all the companies that make up that index. So for example, arguably the most popular stock market index is the S&P 500. It is an index that tracks the 500 largest publicly traded companies in the US. So for an index fund to track the S&P 500, it is made up of all the 500 largest companies that is part of that index. If the index itself adds or drops a company, then the index funds that are tracking that index need to follow suit and add or drop that company from their portfolios. Now, these features that distinguish index funds from all other mutual funds are extremely important, and I'm going to explain why as soon as we cover ETFs. So what are ETFs? ETFs are similar to mutual funds in that they're a collection of stocks or bonds or other securities that diversify your portfolio. But unlike mutual funds and index funds that you buy directly into from the companies that manage them, ETFs trade like stocks and are basically available on the open market like the New York Stock Exchange or NASDAQ. The price you pay to buy into or sell out of an index fund or a mutual fund is determined at the close of the trading day, while the price you pay to buy or sell an ETF fluctuates during normal trading hours, and you can place your order at any time. So for example, if you want to buy into VTSAX, which is Vanguard's really popular total stock market index fund, then you simply go to Vanguard, you open an account with them, and then you go ahead and buy into the fund at the end of day trading price. If you're interested in buying the ETF version of VTSAX, then you simply look up the stock ticker VTI in any of the major brokerage accounts like you would with the stock, and then you can go ahead and buy one or more share of VTI at any point during the normal trading hours. It's worth mentioning that some of the most popular ETFs in the world track indices just like index funds. So if you have an index fund in mind, there's a really good chance you'll be able to find an ETF cousin of that fund somewhere. Now that you have a high-level understanding of what mutual funds, index funds, and ETFs are, let's get into the nitty-gritties of what the differences and similarities are. Let's go back to our discussion about actively managed versus passively managed. Now, I had mentioned earlier that mutual funds are actively managed funds while index funds are passively managed. And I should mention that ETFs are, for the most part, passively managed as well. So passively managed funds have some big advantages over actively managed funds that may seem counterintuitive at first. You would think that Wall Street experts who are paid a ton of money to pick stocks as a full-time job should be able to beat the market overall. But countless research studies have shown, based on historical data, that this is just not true. In fact, it's really rare to find an actively managed fund that beats the stock market, the overall stock market, consistently over the long run. And sure, you can find mutual funds that outperform the market once in a while, but past performance isn't a really good predictor of future performance, because mutual funds that performed really well one year tend to do horribly the next. And the thing is, you can't predict ahead of time which mutual funds out of tens of thousands out there is going to outperform the market in any given year. Not only do the vast majority of actively managed mutual funds underperform compared to the market, but it gets worse. When you buy into those actively managed funds, those expert stock pickers, Wall Street geniuses, and their supporting team, and all the costs associated with them, they're really expensive. And those who buy into the fund are on the hook to pay those costs. And often this is regardless of how the fund performs because of something called the expense ratio. Actively managed funds generally have high expense ratios, while passively managed funds tend to have low expense ratios. And if you've never heard of the term, an expense ratio is basically telling you how much of the fund's money is being used to pay the people who manage the fund and all the costs and expenses associated with that. The average expense ratio for an actively managed mutual fund tends to hover around 0.5 to 1%, while an index fund tends to be around 0.2%, but even the most popular index funds like VTSAX and VFIAX have expense ratios that are 0.04%. While the differences in these ratios seem pretty small, it turns out that in the long run, shaving a few decimal percentages in expenses can save you tens of thousands of dollars. Now, index funds tend to have much lower expense ratios than mutual funds, but ETFs sometimes have even lower expense ratios than even index funds. For example, you can take a look at something like VTI, which is the ETF equivalent of VTSAX. VTI currently has an expense ratio of 0.03%. However, the downside of ETFs is that they typically come with trading costs that are similar to when you're trading stocks. At this point, you might have noticed the writing on the wall, in that actively managed mutual funds are disadvantaged in big ways. And really, index funds and ETFs are your best choices for growing your wealth for all the reasons that I mentioned. This is why index funds and ETFs have exploded in popularity, and money continues to flow out of actively managed mutual funds and into passive index funds. So for the rest of this video, I'm going to narrow the focus down to those two. Let's move on to another cost people often don't think about, but should be a factor in deciding between an index fund or an ETF, and that is taxes. Now, taxes shouldn't be a concern if you're investing strictly within a tax advantage account like a 401k or an IRA or a 403b. Generally speaking, if you are investing through a tax deferred account, then you will pay regular income taxes when you take the money out. If you are investing in an after-tax account, then you don't have to pay taxes when you divest. However, if you are investing through a taxable brokerage account, you will want to consider the tax implications of investing in an index fund or an ETF, and here is why. Both types of funds are taxed on capital gains, but ETFs are structured in a way when the fund itself needs to sell assets to rebalance or for any other reason, the capital taxes incurred by the ETF is lower compared to an identical situation with an index fund. Ultimately, those tax costs are passed on to you as a part owner of the fund. And fortunately, index funds and ETFs are very good at minimizing this cost because of low turnover compared to an actively managed mutual fund, because these index funds and ETFs don't really trade or sell their assets very frequently. So what does this all mean for you? Well, generally speaking, since index funds pay a bit more in taxes because they're less tax efficient structure, it makes sense to buy it in a tax advantaged account. But if you're investing in a taxable account, then ETFs make a better choice to avoid paying more in taxes. And obviously, the more money you're invested, the bigger the tax consequences. Moving on to another consideration between index funds and ETFs is the minimum required to invest. And basically here, what we're trying to compare is how easy is it to buy into an index fund versus an ETF. ETFs, as I mentioned earlier, trade just like stocks. And so you can buy one share of an ETF at whatever price it's trading at, whether it's $100 or whatever, and you are now invested in that fund. For example, VTI right now is currently trading at about $150 per share. Whereas for index funds, some of them like Vanguard's VTSAX or VFIAX have a $3,000 minimum requirement to buy into the fund. Not all index funds have a minimum requirement, but your options are somewhat limited if you don't have that much cash to start investing. The next difference between index funds and ETFs is the fact that you can easily buy fractional or partial shares with an index fund, but it is not so straightforward with an ETF. So for example, going back to the VTI ETF, if you don't have $150 to buy into VTI, then you may be out of luck. But whereas with an index fund, you can buy fractional shares without much hassle. The reason is that some brokerages allow you to buy fractional shares of an ETF, but others do not. So if you ever need to move your money to a different brokerage, how those fractional shares are treated can get really complicated. So in a nutshell, check with your brokerage to see what they will allow, and be aware that things can get a little hairy if you ever need to move your money. So now let's talk about how to decide whether an index fund or an ETF is right for you. At a high level, I think this boils down to 3 questions. First question is, do you have a lump sum of cash to invest? If you have a lot of cash, and I'm talking at least a couple $1,000s, you should have no problems meeting the minimum requirements to invest for virtually any index fund. Second question is, how much liquidity do you need? If you ever need access to the cash fast, then an ETF is going to be probably a better fit for you. However, the downside of that is that you'll be tempted to take the money out at any time, and that basically defeats the purpose of staying in the market for the long term. Third question is, what kind of account are you investing in? Consider index funds if you are investing inside of a tax advantaged account. If not, ETFs might be more tax favorable for you if you are investing in a taxable brokerage account. If you enjoyed this video, be sure to drop a like down below and share with a friend if you think it'll be helpful for them in any way. Be sure to subscribe to my channel so that you don't miss out on any new videos to grow your wealth and achieve financial independence. And don't forget to head over to the next comparison video on all 3 funds by your wealth mentor, Tiffany Thomas, for more insights, which I linked down in the description below. Thanks for watching, and I'll see you guys next time.